In 1992, financial markets teetered on the brink of chaos. The world's financial markets are buzzing with uncertainty. The British pound is under immense pressure, and the Bank of England is desperately trying to defend it. This video is about how the Bank of England's actions during this crisis didn't just impact Britain but had ripple effects around the globe. Let's dive right into the story of how the Bank of England tried to defend the pound in 1992 and what ultimately led to its failure. Back in 1992, Britain was part of the European Exchange Rate Mechanism, or ERM. This was a system designed to keep the pound's value within a certain range against other European currencies. However, Britain faced a significant challenge due to high inflation and a slowing economy, which made it difficult to maintain the pound's value within the ERM's prescribed range. The Bank of England, led by Governor Norman Lamont, faced a challenging situation in 1992. They needed to keep the pound sterling strong by raising interest rates to attract foreign investors. However, higher interest rates also hurt the economy by increasing borrowing costs and reducing investment. It was a classic lose-lose situation. So on September 16, 1992, something pivotal happened. The speculative trader George Soros, nicknamed the man who broke the Bank of England, began heavily selling pounds, betting that the pound would fall against other major currencies. The Bank of England responded by raising interest rates to 15%. This was a desperate move to attract buyers and support the pound, but it didn't work. For every pound the Bank of England tried to prop up, George Soros and other speculators sold another. Think about this. Imagine you have a rubber band stretched tight. If you stretch it too far, it snaps. In 1992, the Bank of England was stretching that rubber band to its breaking point in its efforts to maintain the pound's value within the European Exchange Rate Mechanism, ERM. By September 16, 1992, the Bank of England was hemorrhaging money. The government had spent billions of pounds trying to defend the currency's value within the European Exchange Rate Mechanism, ERM, but the pressure was too great. The Bank of England had to capitulate and allow the pound to depreciate, leading to the pound's exit from the ERM. Now, let's talk about why this happened. The Bank of England was combating economic realities it couldn't control. Britain had a substantial budget deficit, and economic growth was sluggish. Raising interest rates to extraordinarily high levels wasn't addressing these fundamental issues. The Bank of England's strategy was like trying to fix a leaky roof with duct tape. It could provide temporary relief, but was ultimately insufficient for the long term. The economic challenges were too significant to be addressed solely through interest rate adjustments. What does this mean for you? It means that financial crises are often about more than just market movements. They reflect underlying economic weaknesses. Relying solely on high interest rates to address these issues is ineffective, much like trying to stop a leaky boat with a band-aid. So how did the Bank of England's actions affect the economy? When the pound fell, it became cheaper for British consumers to buy imports, which could boost domestic spending. However, it also made it more challenging for British businesses to sell their goods abroad due to higher prices for foreign buyers. This economic shift had broad implications, impacting recovery efforts that extended over several years. Now let's look at the numbers. $5 billion to defend the pound. That's like trying to stop a tsunami with a garden hose. It simply wasn't enough. Imagine if you had £1,000 in a savings account during the 1992 sterling crisis. As the pound weakened, your money was worth less when converted to other currencies, reducing your purchasing power without you actively realizing it. But there's a bigger lesson here. The Bank of England's failure wasn't just about bad decisions, it was about attempting to resist economic realities. When you're up against a tidal wave, you need more than sandbags. So how did this affect the financial markets? It demonstrated that central banks have limitations. They cannot always control market outcomes. This lesson remains relevant today. When economic fundamentals are weak, markets will eventually reflect this reality. Now let's zoom out a bit. The 1992 sterling crisis was a turning point for financial regulation. It led to changes in how central banks manage currencies and how governments formulate economic policy. It wasn't just about the pound, it reflected broader systemic issues in the international financial system. So how does this apply to you? It's important to understand that financial markets aren't just about numbers, they reflect economic realities. If the economy is weak, the markets will show it. This is like a canary in a coal mine. When the canary stops singing, it's a sign that something is wrong and action needs to be taken. But here's the real kicker. The Bank of England's failure highlighted that speculation can have a significant impact. Traders like George Soros can influence markets in ways that central banks may struggle to control. It's like a game of chess where the pawns can take down the queen. Now let's look at the aftermath. Britain left the exchange rate mechanism, ERM, in September 1992 and the pound was allowed to float freely. This meant that the market could set its own value for the pound. Over time, the pound stabilized and the economy began to recover, but the damage was done. The crisis highlighted that even the most powerful central banks can be vulnerable. It's like a boxer who takes too many punches and loses their balance. Now let's circle back to what you can do. Understanding these lessons means you can make better financial decisions. If you observe weakening economic fundamentals, don't be surprised when the markets react. It's like seeing dark clouds before a storm. So what's the takeaway? Financial crises are often about more than just market movements. They reflect underlying economic weaknesses. If the economy is fragile, markets will show this vulnerability. It's like observing a building with cracks and recognizing that it may eventually crumble. Now let's talk about the future. The 1992 sterling crisis taught us that central banks can't always control currency markets, but it also demonstrated that understanding economic fundamentals can help investors navigate financial storms. Imagine you're sailing a boat. You can't control the wind, but you can understand it. Knowing the wind's direction helps you steer your boat better. The same goes for financial markets. Understanding economic fundamentals helps you navigate them. So what can you do to stay informed? Keep an eye on economic indicators such as GDP growth, unemployment rates, and budget deficits. These metrics provide insights into the health of the economy. If the economy is weak, markets may become more volatile. And here's a concrete tip: don't panic. When the markets start to fall, don't rush to sell. Instead, think about your long-term goals. If you're saving for retirement, consider keeping your money in safe, stable investments. Panic selling is like selling your house before the appraisal, often leaving you worse off. Remember, this information is for educational purposes only and does not constitute financial advice. But here's the most important thing. The Bank of England's actions in 1992 were a reminder that markets are complex. They're influenced not just by numbers, but also by human behavior, economic fundamentals, and global events. Understanding this complexity is your best defense against financial crises. So, the next time you see the markets wobbling, remember the 1992 Black Wednesday crisis. It wasn't just about the pound, it was about understanding the bigger picture. In short, the Bank of England's actions in 1992 taught us that markets are influenced by more than just interest rates. They're shaped by economic fundamentals. Understanding these fundamentals can help you navigate financial crises better. In 1992, the Bank of England faced a monumental challenge as the UK economy came under intense pressure from foreign currency speculators. The pound sterling was under assault, and the bank's interventions to defend the currency ultimately failed. This event wasn't just a blip in economic history, it was a stark lesson in the complexity of financial markets. Imagine you're holding a balloon filled with water. You can squeeze it with all your might, but if the pressure outside is too strong, the balloon will eventually burst. That's what happened to the pound in 1992. No matter how much the Bank of England tried to prop it up with higher interest rates, the global economic environment was simply too unfavorable, leading to the pound's collapse that September. The crisis began when speculators, led by figures like George Soros, bet heavily against the pound. They saw that the UK's economic fundamentals were weaker than the currency's implied strength suggested. The Bank of England's defense strategy was to raise interest rates drastically, hoping to make holding the pound more attractive to investors. However, higher interest rates can stifle economic activity, making it even more difficult for the UK to maintain competitiveness in global markets. On September 16, 1992, dubbed Black Wednesday, the Bank of England's attempts to defend the pound finally crumbled. Despite hiking interest rates to a staggering 15%, the currency's value continued to fall. Market participants recognized that the economic fundamentals were too weak to support the high interest rates, and the bank's efforts were ultimately unsuccessful. This episode shows that financial markets are not just about interest rates and numbers. They reflect broader economic realities and human behavior. When the economy is weak, even the most aggressive monetary policies can struggle to maintain a currency's value. Understanding these dynamics is crucial for grasping financial market behavior. Think about it. If you're an investor, you need to look beyond the latest rate changes. You need to consider the overall health of the economy, the political stability, and the global economic climate. In 1992, the Bank of England faced a critical moment when it was forced to abandon the European exchange rate mechanism, ERM. This move, in hindsight, was necessary to allow the UK economy to adjust and find its footing. So the next time you see the market swinging wildly, remember the lessons from 1992, when the Bank of England faced a significant challenge in defending the pound sterling's position in the European exchange rate mechanism, ERM. Markets are shaped by a complex interplay of factors, and understanding this complexity is your best defense against financial crises. Tomorrow on the Money Files, flexible work arrangements. This is educational and historical, not financial advice.